What if I told you that the very moment most investors are quietly walking away from the UK property market, that is the exact moment the biggest opportunity in years is sitting right in front of them? Not in 5 years, not next decade, right now. And the investors who understand what is actually happening beneath the surface of today's headlines, they are going to look back at this moment and call it the turning point. So before you make any move with your money, stay with me, because what I am about to share could genuinely change the way you see UK property forever. Welcome back to NestPath UK, the channel where we cut through the noise and bring you real, data-backed insight for serious property investors. If you are new here, hit subscribe right now, because this is exactly the kind of content we deliver every single week. Now let me set the scene for you, because what is happening in the UK property market right now is genuinely fascinating. On the surface, things look a little uncertain. You have got mortgage rates that crept back up after a brief dip. You have got headlines screaming about falling prices. You have got the Halifax reporting that average UK house prices dropped by 0.5% between February and March of this year alone. The average is now sitting at around 299,677, according to Halifax, while Nationwide puts it slightly lower at 277,186. And for most people, most average observers, those numbers feel like a warning sign. They feel like a reason to step back, wait, and see what happens. But here is the thing. That thinking, that is exactly what separates the average investor from the extraordinary one. Because the data tells a completely different story, if you know where to look. Let me take you back to something that happened in 2012. The UK had just crawled out of one of the worst financial crises in modern history. Property prices were still weak. Investor confidence was shattered. The newspapers were full of doom. And yet, the investors who bought in 2012 and 2013, the ones who went against the tide, they ended up making some of the most extraordinary returns in a generation. History does not repeat itself exactly, but it does rhyme. And right now, it is rhyming very loudly. Here is what the data is actually showing us in 2026. Yes, prices have softened in some regions. Yes, there is uncertainty around interest rates. Yes, Middle East tensions have shaken confidence and caused some economists to revise their forecasts downward slightly. Pantheon Macroeconomics, for instance, adjusted their house price growth prediction for 2026 from 3% down to 1%. That sounds negative, but think about what that actually means for a property investor. It means prices are not crashing. They are simply pausing. They are recalibrating. And in that recalibration, in that brief window of softness, opportunity quietly appears. Because while the headlines are focused on short-term dips, the longer-term picture tells a completely different story. And I want you to understand this deeply, because it matters enormously for your strategy right now. Savills, one of the most respected property forecasters in the UK, is projecting that UK house prices will rise by approximately 24.5% over the 4 years between 2025 and 2029. That would take the average UK property to around $336,000 by the end of that period. JLL, another heavyweight in property analytics, is forecasting cumulative growth of nearly 20% over the same 5-year window. And the Office for Budget Responsibility, the government's own independent watchdog, has forecast average annual house price growth of 2.5% from 2026 onwards. These are not random guesses. These are institutions with enormous research teams, deep data sets, and serious reputations on the line. So here is the question you need to be sitting with right now. If prices are temporarily soft today, and the long-term trajectory is clearly upward, what does that tell you about when to act? But before I give you the answer, and I will in just a moment, I want to make sure you understand why this upward pressure is not going away, because understanding the why is more powerful than just following someone's advice blindly. And at NestPath UK, we never just tell you what to do. We tell you why, so you can think like an investor, not just act like one. The UK has a housing supply problem that is structural. It is baked into the foundations of the country. Demand for homes consistently outstrips the pace at which new homes are built. Planning restrictions, land availability, build costs. These are not problems that get solved overnight. They are problems that have persisted for decades and will likely persist for decades more. And what happens when demand is strong and supply is limited? Prices, over time, can only move in one direction. Add to that the reality that the Renters' Reform Act, which came fully into force in 2026, is already beginning to push smaller, more nervous landlords out of the buy-to-let market. Many of them are selling up. That means fewer rental properties available for tenants, which drives rents higher. And higher rents make property investment more attractive for yields. Savills is forecasting rental growth of 12% cumulatively over the 4 years to 2029. The current average rental yield across the UK is sitting at 5.8%. For a leveraged investor who understands how to use financing effectively, that yield number is genuinely exciting. Now let us talk about where the real opportunities are hiding, because this is not a uniform market. This is not one single story happening everywhere equally. And if you are investing in UK property without understanding the regional picture, you are essentially flying blind. Scotland right now is performing exceptionally. Zoopla's data identifies Scotland as the standout market for house price growth in 2026. In cities like Glasgow and Edinburgh, demand is intense and supply is tight. Only 6% of sellers are having to cut prices to secure a sale. In places like Motherwell, homes are selling in as little as 14 days. In Falkirk and Kirkcaldy, annual price growth is already reaching 4.7%. And crucially, the average property price in many of these areas is still sitting well below $200,000. That combination of strong growth and relative affordability is rare, and it is exactly what smart investors are looking for. Meanwhile, in the north of England, the story is similarly compelling. Markets across the northwest, Yorkshire, and the Midlands are outperforming the national average. Lower average prices mean better affordability for buyers and renters alike. Wage growth in these regions is meaningful. And transport investment, particularly the continued development of rail and road infrastructure, is gradually making these cities and towns more connected and more desirable. When connectivity improves, values follow. It is one of the most reliable patterns in UK property history. Now compare that to London and the Southeast. And I say this not to write off those markets entirely, because prime London has its own dynamics. But the data is clear. In the Southeast, roughly 1 in 6 homeowners is currently reducing asking prices by more than 5% just to secure a sale. In parts of Canterbury, nearly 20% of properties have seen significant price reductions. Affordability is the ceiling. And with the highest mortgage costs and the highest stamp duty bills, the headroom for growth in these regions is genuinely limited in the near term. That is not a reason to panic if you already own property in the south. It is a reason to think carefully about where your next pound of investment goes. Let me pause here for a moment, because I want to address something I know some of you are thinking. You are looking at the mortgage rate environment and you are concerned. And that concern is entirely legitimate. Rates did creep back up in early 2026, partly driven by global uncertainty, particularly tensions in the Middle East. The Halifax attributed its March price dip specifically to that factor, rising mortgage rates reducing buyer confidence and demand. So yes, financing is more expensive than it was in 2020 and 2021. Nobody is pretending otherwise. But here is the critical context. The Bank of England is still on a path of gradual rate reduction. Inflation is cooling. And the consensus among economists is that rates will ease further through 2026 and into 2027. When that happens, and this is the mechanism that matters, mortgage affordability improves. More buyers re-enter the market. Demand increases, and prices, already undervalued in many regional markets, begin to rise with meaningful momentum. Rightmove actually recorded the largest ever January asking price increase in January 2026, a 2.8% jump in a single month. That is sellers entering the market with confidence. That is a signal. And stock levels right now are at a 12-year high, which means buyers and investors have more choice than they have had in over a decade. More choice means better negotiating power. Better negotiating power means you can acquire assets below their true long-term value. This is the window. This is the setup that sophisticated investors dream about. The combination of temporary softness, high stock availability, motivated sellers, and a clear medium-term upward trajectory. It does not last forever. It never does. Now let me give you something concrete. 3 regions and 3 types of property that are particularly worth paying attention to right now. The first is terraced and semi-detached homes priced under $200,000 in Scotland's Central Belt. The data is unambiguous here. Fast sales, minimal price reductions, strong demand, and affordability that still makes sense for both owner-occupiers and renters. If you are a buy-to-let investor, this is a market where your yield story stacks up and your capital growth story stacks up simultaneously. The second is purpose-built rental accommodation in northern English cities, particularly Manchester, Leeds, and Sheffield. The build-to-rent sector is booming. Institutional money is flowing in because the fundamentals are undeniable. Young professionals want high-quality, well-managed rental accommodation. They want flexibility. They want amenities, and they are willing to pay for it. If you are thinking about your next investment, this category deserves serious attention. The third, and this one is slightly contrarian, but hear me out, is commuter belt properties in the Midlands, particularly around Birmingham and Coventry. The Commonwealth Games legacy investment, ongoing HS2-related development, and Birmingham's growing status as a genuinely global city are all factors that are quietly but consistently driving up demand. Prices in this region are still significantly lower than London equivalents, but the gap is narrowing. And when gaps narrow in property, investors who got in early are the ones who benefit most. Let us also talk briefly about what you need to do with your financing strategy right now. Because even the best property in the best location will not deliver returns if you have structured your debt poorly. With rates having risen from their post-pandemic lows, the era of simply assuming that a variable rate mortgage would always stay cheap is over. Fixed rate products, particularly 2- and 5-year fixes, are worth serious consideration right now, especially if forecasts for rate cuts materialize. You lock in at a rate that reflects current conditions, and if rates fall further, you refinance. You do not over-leverage. You stress test your numbers at a rate that is at least 1.5% to 2% higher than your current deal. That is not pessimism. That is professional risk management. And one more thing that serious investors almost never talk about publicly, but which makes an enormous difference to long-term returns, is buying power during periods of seller motivation. Right now, 1/3 of properties on the UK market have had their asking prices reduced. That is a statistic that deserves a moment of silence. 1/3. That means there is a significant portion of this market where sellers are already psychologically prepared to negotiate. They have already moved once. They are ready to move again. For an investor with cash or a mortgage decision in principle already lined up, that is extraordinary leverage. At NestPath UK, this is what we mean when we talk about investing with intelligence rather than emotion. The emotional investor looks at a softening headline and walks away. The intelligent investor looks at the same headline and asks, "What does this mean for my next purchase?" I want to leave you with one final thought, and it is something I genuinely believe, having watched UK property through multiple cycles. The investors who will look back at 2026 with the biggest smiles are not the ones who waited for perfect certainty, because perfect certainty never arrives in property investment. The ones who will be smiling are the ones who understood the data, understood the fundamentals, chose their locations with precision, managed their financing with discipline, and acted while others were still debating. The window between a dip and a boom is always shorter than people expect. And when prices start moving upward with momentum, and they will, the opportunity you are looking at today will feel like a distant memory. The UK property market has absorbed stamp duty changes, budget uncertainty, global shocks, and a decade of volatile interest rates. And it is still standing, still growing, still fundamentally undersupplied. That is not weakness, that is resilience. And resilience, combined with the right timing, is the foundation of exceptional investment returns. So here is what I want you to do next. If this video has made you think differently about where the market is heading and where the real opportunities are, drop a comment below. Tell me which region you are most interested in. Tell me what is holding you back from your next move. I read every single comment on this channel, and I will respond to as many as I can. And if you found this valuable, and I genuinely hope you did, please like this video right now. It takes 2 seconds, and it helps NestPath UK reach more investors who deserve to see this kind of analysis. Subscribe if you have not already. We release content every week. No fluff, no filler, just real property intelligence for investors who take this seriously. And if you want to go deeper on any of the regions or strategies I mentioned today, I have linked some additional resources in the description below. I am glad you are here. I will see you in the next one.